Have you noticed something weird happening? Maybe your savings account changed, or a new mortgage quote wasn't what you expected. Your friend's getting a decent return. Is your interest rate creeping up? Your money is about to change. This week, not next year, this week. One decision could raise your mortgage or finally pay you for saving. Here's exactly what's happening. If you're wondering who brought all of this to life, let me introduce myself. My name is Onyinyechi, and I'm the creative mind behind Amanda Drama TV. We don't just show products. We bring them to life. Why your money is about to change. Finance is going purely digital. Look at this upward trend. This affects everyone. Your money is about to change. And the strange part is, you might not notice it happening. Not at first. Because when people hear the words, that has nothing to do with me. But let me show you something. That little number called an interest rate can quietly affect your mortgage and even the price of borrowing money across the economy. And right now, the financial markets are watching a very important week. The Jackson Hole Economic Policy Symposium is happening August 27 through 29, 2026, and financial markets are paying close attention to what policymakers have to say. Jackson Hole is not where the Federal Reserve officially votes to set its interest rate target. The next scheduled meeting is September 15 and 16. So why is everyone paying attention to Jackson Hole? Because sometimes the words at Jackson Hole can change what investors expect. We follow words, expectations, markets, and your money. So stay with me. On this channel, we break down complicated money stories. No complicated Wall Street language, no pretending we can predict the future, and no telling you that one investment is guaranteed to make you rich. Today, something much more useful. I'm going to show you the chain reaction. By the end of this video, you'll understand why this week's bond and most important are watching the Federal Reserve. And most importantly, what you should actually be paying at your life. Let's start with the simplest part. Imagine I give you $100. You keep it for 1 year. At the end of the year, you give me back my $100 plus $5. That extra $5 is the price of borrowing my money. That's interest. Now reverse the situation. You put $100 into a savings account. The bank uses your money as part of its funding, so now you're the lender. This is why interest rates matter. They affect the reserve. Now let's talk about the Federal Reserve is the central bank of the United States. One of the most important tools it uses is its target range for the federal funds rate. As of the Fed's July 2026 meeting, that target range was 3.5% to 3.7%. But don't worry about memorizing that number. Instead, remember this. The Fed is constantly trying to balance two major problems. Inflation on the left side, slow economy on the right. If inflation's too strong, rates go up. If the economy's weak, rates go down. It sounds simple, but it isn't. Because the economy isn't a light switch, it's more like a giant machine with thousands of moving parts. And here's where your money enters the story. When interest rates changes, businesses and bond prices can react. Stock valuations can react. This week is getting so much attention. Now let's talk about Jackson Hole. Every year, economists, central bankers, polymoming. This year's event is especially interesting because markets are all rails. The bond market, if you've never understood bonds, don't worry. I'm going to demonstrate it in about 20 seconds. Imagine the US government needs to borrow money. Instead of asking one person for a giant loan, it can issue government securities. Investors buy those securities, the government receives money, investors receive interest, according to the terms. That's the basic idea. Now imagine investors suddenly becoming less comfortable. They may demand higher yields. And when yields rise, borrowing costs can feel pressure. That is why they matter. Governments borrow money from investors. This matters for things like mortgages, not because your mortgage is literally a treasury bond. Oh, they're just printing money to make everything better. That's not what this means. The Treasury's buybacks, management, and market liquidity tool. They help improve trading conditions in parts of the Treasury market. But they don't magically eliminate the deeper forces affecting long-term yields. And that's the interesting part. Because markets are still watching inflation, those four things are now sitting somewhere in that room too. Let's forget Wall Street for a minute. Forget billion-dollar funds. Forget financial television. Let's talk about you. Imagine you are trying to buy a home. You find one you love, and suddenly, the monthly payment is much higher than you expected. Let's use a simple example. Suppose someone borrows $300,000 for 30 years. That's why small-looking percentage changes can become large dollar differences over many years. And notice something. You didn't need to become an economist only. What did the Fed say? You just needed to see the calculation financial news. Don't ask only what to say. Ask, what does this connect to? Now let's move to savings. Here's the part many people completely overlook. Interest rates aren't just bad news, they can be good news for savers if banks offer competitive yields. At 0.01%, at 4%, $10,000 earned. Don't just ask how much you have. How much? What is it doing? Is it sitting somewhere earning almost nothing? Is it invested? Is it paying down expensive debt? Your financial position isn't only about the amount in your... Now let's talk about something less exciting, your credit card. I know, nobody wants to talk about credit cards. If your balance carries a high interest rate, this is where I want you to do something with me. Grab paper or a calculator. Write down the interest rate. Now find the payment. How long will this take? Personal finance is personal. Crypto is sensitive to changes in risk. Speculative assets can benefit from risk. Nervous investors cause larger swings. Tends to does not mean guaranteed. Be careful with crypto. Interest rates are only one of them. So if somebody tells you rates are going down, therefore this asset must go up, that's not analysis. That's certainty pretending to be analysis. And nobody can guarantee what a market will do next. Let's go back in time. Now I want to show you why today's story shouldn't be viewed in isolation. Let's go back to 2008. The financial crisis was devastating. The economy was under enormous stress. Everything we built is just gone. I don't know how we survived this. So here's the lesson. That question is incredibly important. Inflation became extremely high. Low interest rates did not mean everything was. The economy was in serious trouble. But notice something important. Low interest rates did not mean everything was good. The economy was in serious, incredibly important. Now let's jump to 2022. Inflation became extremely high. The Federal Reserve responded with a rapid series of rate increases. Borrowing became more expensive. Mortgage rates moved dramatically higher. Never look at an interest rate number without asking, why is the rate moving? That question is incredibly important. Now let's jump to 2022. Inflation became extremely high. The Federal Reserve responded with a rapid series of rate increases. What should I do? Okay, you've seen the markets, crypto, stocks, and bonds. But here's what matters. What should you do? Here is my checklist. Check your savings rate. Open your banking app. Find your savings account. Look at the interest rate. Don't assume you're getting a competitive rate just because your money is sitting in a bank. Compare. Understand the terms. Compare. Understand the terms, check whether the rate is promotional, and understand whether there are conditions attached. You don't have to chase every percentage point, but you should know what your money is earning. If you're buying a home, understand your rate. Don't look only at the headline rate. Ask about the APR, fees, and lock-ins. The lowest number isn't always the cheapest. 3. Don't panic trade. This is extremely important. One headline isn't a reason to sell everything. Your plan depends on your goals and risk tolerance, not on today's trending headline. This one is extremely important. One headline isn't a reason to sell everything and risk tolerance, not on whatever headline is trending today. Markets move quickly, your plan shouldn't. Credit cards, lines of credit, other variable rate borrowing, find out what you're actually paying. Because if you're carrying expensive debt, that's not exciting, but it can be powerful. Credit cards, lines of credit, other variable rate borrowing, find out what you're actually paying. Because if you're carrying expensive debt, that's not exciting, but it can be powerful. This is probably my favorite one. Don't wait for a crash or mortgage issues. Ask questions and make checkups a habit. You need to be prepared. This is probably my favorite one. Don't wait for a market crash to look at investments. Check early, check often. Be prepared for different possibilities. Let's see if you can remember the entire video in 5 words. Number 1, rates. Number 2, bonds. Number 3, borrowing. Number 4, saving. Number 5, investing. That's the chain. Borrowing and saving. Bond markets influence the cost of the economy, and investor expectations influence markets. Hey everyone! Today I'm planning out my new workspace. I need something that is both functional and beautiful. Let's see what we can come up with together. Welcome to our brand new office space. We are expanding our team this month. I'm making sure everything is ready. Let's build something great together. But your job isn't to predict every move. Your job is to understand what is happening and make decisions that fit your own situation. So here's your homework. Open your banking app, look at your investments, and ask yourself one simple question. If rates stay higher than I expect, am I prepared? Then ask the opposite. If rates fall faster, am I prepared for that too? And that's what I want this channel to be about. Not fear, not hype, not telling you that the next market move is guaranteed. Understanding. Subscribe for more. We'll break down money stories affecting people, one simple explanation at a time. Answer one question in the comments: mortgage, savings, or the stock market? Tell me in the comments below. because your question could become the subject of the next video. I'm Amanda Drama TV. Thank you for staying with me. You don't have to predict the future to prepare what is happening before it reaches your wallet. I'll see you in the next one.